Hello everyone. In this session, I will be discussing about what is T accounts and how the transactions will be recorded using the T account. What is the structure of T account? In the last session, in the last video, I have discussed what is debit and credit and how it will impact different account types. So if you remember how it will impact, debit and credit will impact the different account types, you can easily pass the entry using the T accounts. So now it will be by what is the T accounts. So recording transactions using T accounts. T accounts are fundamental tools in accounting which will provide a visual representation of individual accounts and how they are affected by transactions in the form of alphabet T. Why it is named as T? Because it gets its name from its T shape, where the vertical line divides the account into two sides, the left side and the right side. The left side of T accounts always represent the debit accounts. Whatever in the transactions, whatever the account is debited, that will be the left hand side of the T account. In the right hand side, the opposite of debit, that is the credit accounts, it will be there. T accounts are a fundamental tool for teaching and practicing double entry bookkeeping. Another name for a T account is a ledger account. It will be ledger account. So now T account we have understood. Now we will be I will be discussing about the structure of T account, how the T account will be represented. So each T account will have three main parts. The first part or first component of T account is account title. It's very important whenever we are passing any transactions or any entry, there are two accounts will be involved. So whatever the accounts will be there, the name of the account will be written at the top of the T. So here you can see in the PPT that is written here asset account or any other account. So the account title is in this, it is the asset account. I have discussed about the different types of accounts. So asset can be liability, expense, revenue, any account it will be which will be titled at the top of the T account. Then there will be a debit. You can look into the PPT. Debit is represented or abbreviated as DR. Right hand side is credit, that is the represented or abbreviated as CR. So debit side, the left side of T is where debits are recorded. Credit side, the right side of T is where all the credit transactions will be recorded. So why it is known as T? Because it is representing the alphabet T. So three main component, account title we have to keep at the top of the T account, debit side and the credit side. So for example, here liability, whenever there will be decrease in the liability, it will be recorded in debit side. When there will be increase in the liability, it will be recorded in the credit side, that is the right hand side of the T account. For example, capital account. So again, the capital account, the name of account we will be writing at the top of the T account, that is the capital account. Left hand side debit, right hand side credit. When there will be decrease in the capital account, it will be represented in the left hand side, which is debited, decreases capital. Credit will go to the, whenever there will be increase in the capital, it will be capital account. So these are the transactions. Now already I have discussed how the debit and credit will impact different accounting types. If you have gone through all the concept how these are the different types of accounts will be impacted, based on that we will be recording, I will be discussing some of the examples of recording those transactions using T account. So for example, ABC Limited Company or any company name you can write it, has purchased equipment of rupees 50,000 on credit. So the first step we have to look into that, you have to identify what are the two accounts involved in this transaction. So here company has purchased the equipment. So equipment will come in under the asset accounts. So the first accounts involved is equipment or asset account. Here I have represented as equipment. So it will be easy to understand. Equipment will go in asset accounts. So there are two types of accounts involved in this transaction. The first one is equipment or asset accounts. The second is the accounts payable. Company has taken on credit. That's why it is the liability for a company which the company has to pay 50,000 in future. That's why it will be going to the accounts payable, which includes the liability account. Second step will be determine the type of accounts and the effect of the transactions. So we have identified in this example there are two accounts are involved, equipment and accounts payable account. How it will be increase or decrease it will impact, that we will look into that. So there is a equipment account, equipment coming into the business. So there is a increase in equipment account. Company has purchased the equipment, so there will be increase in equipment account. And the company has to pay. The company has not purchased on cash. Company has purchased this equipment on credit. That's why it will go to the accounts payable account, which will be liability. Company there is a increase in the liability of this much value of rupees 50,000. That's why there is a increase in accounts payable account or liability account. So we have identified the two accounts and how it is increasing or decreasing these two accounts that we have learned. Now we will apply the double entry accounting principles. So what will be the debit? One account will be debit and one account will be the credit. So here debit the equipment account because there is a increase in equipment which is an asset. So it can be debit the asset account or equipment account, and credit will go to the accounts payable account, which is credited because there is a increase in the liability, which represents the obligation to pay the supplier or shopkeeper in the future. They have company has to pay rupees 50,000 in future. That's why it will be credit the accounts payable account. So now how we will represent this T account transactions? There are two accounts are involved, equipment account. So at the top we will be keeping the name of the account, that is the equipment account, debit of rupees 50,000 equipment account, and credit here the second account involved here, accounts payable account, which will be credited of rupees 50,000. So T account transaction we will make like this. You can look into the PPT. At the top we will be writing the equipment account or the account which will be involved, that two account here, equipment account and accounts payable account. Debit left hand side, credit right hand side as rupees 50,000. They have purchased the equipment at the cost of rupees 50,000. So 50,000 have been debited in equipment account and credited in accounts payable account. Another example. So ABC Limited receipt of cash from accounts receivable. So for example, the company or the business receives rupees 75,000 in cash from a customers who previously received services on credit. So you have paid, company has paid any services to their customers on credit. Now they have received that amount, that is the 75,000. So again you have to first identify the two accounts. Here the cash account or asset accounts will be there and accounts receivable accounts will be there. So here now we will be look into the effect of the transactions. So two accounts are there, cash accounts and the accounts receivable accounts. So cash accounts, there is a increase in the value, increase you are getting, company is getting rupees 75,000. So cash account have been increased, and there is a decrease in accounts receivable, that of rupees the same amount 75,000. So there is a decrease in the accounts receivable account. So now apply that double entry accounting principles. Debit the cash account and credit the accounts receivable account. Debit, why the cash account? Because cash is an asset and which will increase with the debits. Why credit the accounts receivable account? Because account is credited, because accounts receivable is an assets and which will decreases with the credit. So this is the entry passed, and this is the examples. You look into the PPT, T account transactions. There are two at the top. I have written both the account name, cash account, and accounts receivable account. Debit cash account of rupees 50,000 and credit accounts receivable account of rupees 50,000. Some other example, how purchasing. Now in the last example I have discussed whenever the company has purchased any equipment on credit, but here now I will be discussing about if the company has purchased any inventory of rupees 20,000 in cash. So here there will be two accounts, inventory account and cash accounts here. And how it will be inventory, because the company has purchased the inventory, so there is an increase in inventory or assets account, and company has paid in cash, so there will be decrease in cash accounts. So there are two accounts involved, inventory and cash accounts, increase in inventory account and decrease in cash accounts. Now we will be applying the double entry accounting principles. So debit will be the inventory account and credit will go to the cash account. Why debit the inventory account? Because inventory is an assets, which whenever there will be increase in assets, it will be debited. Whenever there will be decrease, assets will decrease, that will be going to the credit. So in this transactions, we will be account transactions, we will be represent like this: inventory or asset accounts, and second is cash accounts. Debited with 20,000 the amount, and it has been credited to the cash accounts. Another examples, for example, ABC company issues 1,000 shares of common stock at rupees 10 per share, and they receives 10,000 in cash. So company has issued certain stock shares to the shareholders and they receive 10,000 in cash. So there will be two accounts involved, common stock or equity account and the cash accounts. What are the? There will be increase in equity account, common stock or equity accounts, and there will be increase in cash as well. So it will be apply again the double entry accounting principles, debit the cash account and credit the common stock. Why debit the cash account? Because there is an increase in cash. And why this account is common stock account is credited? Because equity increases with the issuance of shares. That's why it has been credited. Then look into the transactions. Here there are two accounts, cash account and common stock or equity accounts, debited with that particular amount, that is 10,000 in this transactions. So it has been debited to the cash account and credited to the common stock or equity accounts. So in this accounting transactions which are recorded using the double entry accounting systems, which ensures accuracy and reliability in financial reporting. And we have learned each transactions impact at least two accounts, which will be account debited and another account will be credited, and maintaining these fundamental accounting equations of assets which will equaling liabilities plus equity. So assets will be liabilities. So main focus is to maintain this equation, that is assets is equal to liability plus equity. So I have discussed these things. So in this discussion we have covered the basics of debits and credits, what is debit, what is credit, and how they have impact on various account types, and then we have learned about the structure of T account and how use of T accounts for recording different transactions. I have given certain examples, detailed examples we have demonstrated. So how T accounts provide a clear and effective method for visualizing the effect of all the financial transactions. So this understanding is crucial for maintaining accurate and balanced accounting records. So thank you so much. I hope you have clear with the concept of debit and credit and how it will impact the different account types and the T accounts transactions. Thank you so much.